Well, hello, and thank you for joining today's virtual global compliance roundtable, Navigating Risk and Crisis. My name is Stuart Jones, and I'm the CEO and co-founder of Sigma Ratings. As background, Sigma Ratings is an AI-driven risk intelligence and ratings company based in New York, serving clients globally. We specifically help organizations leverage big data to automate and more holistically assess risk across people, companies, and countries via web-based and cloud-based data analytics solutions. As part of our work with global banks, broker-dealers, and corporate clients, we received a number of questions on the impact of COVID-19 on compliance, which led us to put this event together. I don't have to tell you that the world has fundamentally changed. How we work, who we work with, and how we generally think about risk and compliance in this new digital age. To cover as much ground as possible, we assembled a panel of experts who all have deep expertise in navigating and managing risk. We're excited to have this group together to learn from their experience and their perspectives. We also hope that this will be the first of many forums that will explore a variety of specific risk themes in the coming months. So stay tuned for more content. And finally, before brief introductions, I want to highlight that we will have plenty of time for questions. We will do our best to get to them all, but if for some reason we do not, please let us know by submitting a question via Zoom or by email after the event at hello@sigmaratings.com. Before I turn it over to our fabulous moderator, Stacey Warden, let me quickly introduce everyone, starting with her. Stacey, our moderator, is an executive director of global market development at the Milken Institute, where she leads strategic initiatives on developing capital markets, innovative finance, and access to capital. Stacey is also an advisor to Sigma. Stacey previously worked at JP Morgan, NASDAQ, and the US Treasury Department, and works globally with a number of governments in emerging markets. She's also worked tirelessly on the challenging issue of correspondent banking de-risking, which is where we first met. As panelists, we are joined by Bob Werner. Bob leads a consulting practice, Green River Hollow. He is an advisor to Sigma. His background spans work at the state, federal, and global levels. He is the former global head of financial crime compliance at an international bank and led similar functions at 2 other US financial institutions. He also worked at the highest levels of the US Treasury Department as a senior advisor and also leading as a director of both the Financial Crimes Enforcement Network and the Office of Foreign Asset Control. Bob is joined by Zach Goldman, who serves as counsel at global law firm WilmerHale. Zach is an advisor to Sigma. In his practice, Zach focuses on financial crime, financial technology, and national security issues, with a particular focus on financial sanctions, anti-money laundering, cryptocurrency, and other novel payment technologies. Prior to WilmerHale, Zach served in senior roles at US Treasury and as a special assistant to the chairman of the Joint Chiefs of Staff at the Department of Defense. And finally, Michael Greenwald is the director of Tiedemann Advisors, advising the firm's clients on a range of financial options and strategies. Prior to joining his current firm, Michael worked in senior diplomatic roles within the US government, including roles in Africa, Europe, and the Middle East. Among these roles, he served as the US Treasury attaché to Qatar and Kuwait. Michael is a visiting fellow at the Harvard Kennedy School's Belfer Center, is an adjunct professor at Boston University's Pardee School of Global Studies, and is a deputy executive director at the Trilateral Commission. With that, I'm very pleased to begin. I would like to now bring Stacey Warden in to moderate going forward. Stacey, thank you very much, and over to you.
Thanks, Stuart. It's a real pleasure and honor to be able to do this. So the title of this webinar is going to be the impact of COVID-19 on compliance. So what I want to do is I want to start with that impact and try to figure out and unpack what exactly that is. Then we'll move to how banks should be positioning themselves, looking a little bit backwards, how might they have better positioned themselves in a perfect world, and given where we are now, what they might do best going forward, banks and financial institutions. And then the third kind of big bucket for the conversation will be the regulatory front. So what is happening on the regulatory front? What are my panelists hearing? What kinds of the regulatory strictness or potential regulatory forbearance is most important, and how are banks and financial institutions kind of navigating this sort of daily changing world. And then if we have time, because as Stuart said, we do want to leave time for questions, we'll talk a little bit about the role of central banks and maybe CBDCs and kind of US dollar dominance and what that means and what it means for that. So, but to start with the impact, I want you guys to put on your criminal hats and your hyper kind of paranoid hats, and tell us, what potentially could go wrong now? What could criminals be doing to take advantage of this situation? And Bob, and this is in no way, my dear audience, to imply that Bob most easily pivots to a criminal mindset at all. But Bob, I do want to start with you. And you've been around the block, so to speak, a few times on this. So what, with your most paranoid hat on, could be going on right now? And what should banks and financial institutions be particularly worried about?
All right, thanks, Stacy, and welcome everyone. So I'll answer the question in two parts, because I think it's also important to think about some of the compliance risks that flow from this for banks and other financial institutions as well. But from the criminal perspective, unfortunately, we don't know all the risks, because criminals are extremely creative and adapt very well, and so we'll learn some new ones in the course of this event. But some of the tried and true ones that we all should be thinking about, of course, are scams and frauds, and they'll take a lot of different forms. But certainly we'll see a category of financial assistance scams where individuals who are in need are offered financial assistance by seemingly good guys and women who are going to help them get money or lend them money or help them apply for financial assistance. And what's really going on is either they're trying to suck fees out of them and then they'll disappear, or even worse, they're phishing for critical financial information, which they'll then use to hack their bank accounts and their impact their credit ratings and other horrible things like that. The other area we'll certainly see issues in is with respect to banks is going to be loans. Lots of people applying for loans under various programs, and I know we're going to talk about that in a little bit in greater detail, but applications from fraudsters who aren't who they represent themselves to be, aren't using the money the way they're supposed to, et cetera. And then the third category that we're certainly going to see a lot of activity in is charities. Lots of fake charities out there requesting donations so that they can help all the people in need. These are particularly pernicious in that they always have a wonderful mission, but the money's not going where it's supposed to go. It's going into the pockets of fraudsters and criminals, and which is terrible, because it diverts that money from real charities. I think we're also going to see some significant cybersecurity risks from cyber criminals who want to take advantage of the fact that so many people now are working remotely, and often many of us are working on systems that weren't designed for the capacity that we're seeing. And may not have been designed with the security in mind for the scope and extent of the work. So those are sort of the major criminal things I see right off the bat. And then from a compliance perspective, we're going to see issues around information privacy. Are people going to be allowed to print from home? How are they going to store documents? As things are mailed to people, paper. How secure is that? How sensitive is it? Devices being mailed to people, are they encrypted? Flash drives, et cetera. So information privacy and security will be a significant issue. Also for banks, with so many employees working remotely, the ability of the financial institutions, not just banks, but other regulated institutions that have monitoring and surveillance obligations, how are they carrying those out? Particularly when you have things like remote trading and things that traditionally are done on site. And then just the ordinary risk from lack of productivity or reduction in productivity that may result in backlogs, slowdown in remediation, and just the basic maintenance of processes and policies and programs.
So let me toss out, that's a very comprehensive kind of taxonomy of what could go wrong theoretically. Let me ask as a follow-up question, have any of you seen anything or heard anything in particular that's already sort of started, nefariousness that's already going on, or is this, has anything kind of popped its head up already?
Well, Stacey, I'll jump in. I mean, I think beyond that, we've seen terrorist groups like ISIS and Al Qaeda. We've seen them tell their groups to target Westerners given this virus. Even under that, I think from the family office perspective, we have to educate our clients on cyber risk, building on Bob's point. So it's an ongoing education. I mean, that cyber education begins in the beginning, but I think during this time, you have to create an entire new education plan. And that requires, there also is a bit of wariness on DocuSign and how much protection there is in DocuSign, because I think there is so many more documents being done virtually. So I think there needs to be education at every level as well. But I know Zach can build on the cyber discussion.
Yeah, and just to add, I think Michael's right. A lot of this is targeted at all our clients as much or more than at the institutions themselves. One of the things that I've been hearing about are counterfeit goods or false goods represented to be something that they're not. For example, N95 masks that turn out to be dust masks is a classic example. But I think a lot of the consumers need to be really careful about this, who they're buying from and how they can verify that the goods they're buying are what they're represented to be. And then price gouging in terms of what people are being charged is something that of course we're all seeing, even on some of the more standard websites.
Yeah, I think I bought a couple of those masks on Amazon, actually. Zach, let me follow up with you a little bit on the cyber. And so for me, and again, I'll throw this out to anybody. For me, the JP Morgan trading floor story was very sad about, sort of the infection that took place because people were kind of called back onto the trading floor. But I can imagine running that business and being very unclear about what to do. I mean, you maybe don't have the audit trails and the kind of mechanisms for people that work from home. You haven't thought about it. You don't have it sort of up to speed. You need people where they should be, but at the same time, you don't want to put employees at risk. And how do you kind of think through those issues, and what should banks be doing about that?
Yeah, so thanks everyone, and Stuart and Sigma for putting all these wonderful people together this morning. So, I mean, I think as I understand it, banks are taking kind of varied approaches to managing cyber-related risks pertaining to things like insider trading controls and things like that, there certain people are coming into the office who need to be in the office, but they're staggering shifts and breaking people up into different locations, so you have a sort of lower density of employees and people aren't putting each other at risk for contracting COVID-19. So I think they have. I think they have. So the larger banks have, I think, invested a lot in developing redundancy plans and disaster recovery and backups and things. I'm assuming are not always working perfectly, but they're working reasonably well. I mean, I think the things that I think about from a systemic perspective are when you get below the kind of top tier financial institutions who have the resources and the personnel to really do serious advanced planning, what do the disaster recovery institutions, disaster recovery responses and backup plans meant to manage crises like this look like? I mean, we have over 10,000 banks and credit unions in this country, and I'm assuming not all of them have the resources to really have multiple backup sites and divide people in two and things like that. So I think thinking through systemic risk from that would derive from prolonged need, many months of need to have people either working from home or working substantially reduced shifts in a physical office in order to maintain the social distancing that's required. I mean, I think that's a really significant challenge in how you scale the kinds of structures that the larger institutions have. So I think that's one thing. Second thing, I want to just kind of build on some points that Bob made. I mean, I think I would put sort of the risks that he described into two categories. One are risks principally focused on the financial institutions, and then the second are risks principally focused on consumers, as to which the financial institutions have both a kind of a less ability to monitor and control risk, and then diminished legal obligations with respect to those risks, right? So the kinds of consumer fraud schemes, there are some legal obligations that attach to those, but that's principally about people being careful with where they send their money. Whereas these lending programs are going to principally manifest themselves, or the risks attendant with these lending programs, rather, are going to principally manifest themselves as risks against the banks and sort of secondarily against the government that's guaranteeing these loans. And so I think, society, folks need to think about these two different risks in different ways. And I would say that the charity risk that Bob identifies, which I think is a significant one, sort of sits at the intersection between the two, because those big charities or charities with poor reputations, they are banked somewhere. They need to be banked somewhere, and the messages from the regulators, from FinCEN, the OCC, and the like, has not necessarily been to relax BSA-related obligations, rather to introduce some targeted accommodations to the environment in which we find ourselves. And I think the risks that Bob identified are exactly why the regulators are not advising folks to relax their sort of allowing them to completely relax their AML program obligations, because the risks are real, and the financial institutions are uniquely suited in some senses to guard against them.
Okay, so let's talk about that sort of targeted accommodation in a minute. But I want to stay on kind of what banks and financial institutions should be doing to right now. So now your business is probably less than it was before. You've got people all over the place. You have a lot of pressure on you. You've got limited compliance budgets. What should you be spending your money on? If you had an agile organization, how should you be moving people, and what should the priorities be? And maybe I'll just kind of go around the room, so to speak, and give some advice to banks and financial institutions, all of you, to like, what should you be most focused on now? Michael, I'll start with you.
Sure. So I think what this crisis highlighted is which businesses have more sophisticated continuity of operations. So government, U.S. government has a continuity of government operation, and many businesses have crisis plans, as Zach pointed out, but this is not typical in any regard. So I think this highlights who is more tech savvy, who has invested in technology previously, and that's going to really make a difference. So I think I see this from the family office side, working with institutions. Those who are fast, who are quick, who are agile, that can make adjustments, that's where our clients want to go. And so I do think this is going to weed out certain institutions that haven't invested in technology. So right now, Stacy, I would say make a quick move, invest in technology and communication to your internal workforce. I think that's incredibly important, is clear communication, ongoing communication, giving that guidance.
What do you mean on that? Clear communication. Put some meat on that for me.
Well, I think that you need to be setting out very specific guidelines of what this continuity of operation is going to look like. And so there needs to be a sense of structure. So in a time like this, you need to lay out what the next 3 months are going to look like. Give people signposts, give people structure, do a daily call to check in. Don't let your schedule just become loose. And I think that that's important internally, but I think it's also important to be proactive with your clients. I know from the family office side, we've been speaking to clients on a daily or weekly basis, not just on markets, but on education, given the crisis and the cyber concerns that Zach and Bob highlight.
Okay, Bob, what should financial institutions be doing globally?
Globally, yeah. So this is an interesting event, right? Because all institutions do some level of stress testing and continuity of operation planning, but this is actually the 100-year event. This is at the extreme end of the spectrum that everybody says, well, that's never going to happen during our lifetimes. Well, it just happened. And what it's doing is putting a lot of scrutiny around the scalability of operations, because people had things in place, but they needed more so. They weren't enough. And so what
Can you
we're
give us an
seeing now
example
are,
of that? I'm
yeah,
sorry to interrupt. Yeah.
so just conference call capability. A lot of institutions are scrambling now to expand their servers and their broadband capacities because they had the technology to have interactive video calls, but not for as many people as were using it at one time. And so the technology was breaking down and not being as effective. And so that's a classic example where, it's hard to fault the institutions because, again, do you plan at a capacity that's for a 100-year event day after day? But I think
let me ask you that question. You've got shareholders, but this could also happen to you, could put you out of business, something like this. What do you do?
Yeah, so I think what we're learning is even if you don't maintain a capacity level that's at the 100-year event, you have a very clear plan and the ability to get there quickly. So I think it's more about the ability to scale up effectively and efficiently than it is where you are at any one point in time. And I think the institutions that thought that through and had those plans in place had a much smoother transition to a close to business as usual operation than those that didn't. And as Michael said, automation is just key. We saw a lot of institutions that continued to have employees come into the office because they hadn't automated some of the things they needed to have automated in order to remove them from the office. And then you've got, one of the things that we're all going to have to do, regulators and the industry, is scrub some of the archaic requirements that are out there, like wet signatures, which are required in many cases for certain products or changes in business practice, release of funds, et cetera. Again, that pulled people into the office, physically having to be present. So I think the key, would be scalability and the ability to move up the way you need to, and automation.
My brother's a competitive bridge player, and his online bridge tournament provider had to go out and buy like 3 servers because they were so overwhelmed by they didn't plan for this kind of an event.
There's a lot of bridge and canasta at our home right now.
Okay, Zach, what would you tell banks and financial institutions to do now? They find themselves in this situation, and they're maybe a bit more clear on what they should have done, but right now, what can they do to kind of minimize the impacts going forward or take advantage of the situation going forward?
So, I don't know that I have anything to add to what Bob said about disaster recovery and crisis response and things like that. The way I would think about this is to be more sensitive to risk identification procedures moving forward. So, I think that the imperative. So, financial institutions across the board have to face reductions in staff availability, potential reductions in availability of critical systems, things like that. And that really forces them to prioritize risk management, which puts a premium on the ability to identify critical risks. And again, in an economy, the U.S. banking system is different than the banking systems of many of our, OECD peer countries in that it is highly fragmented. That fragmentation creates some systemic protections because it means that bank failures aren't necessarily as contagious as they might be and systematically significant as they might be, but it means that you've got lots of small institutions throughout the country with more limited resources. And so I think, what would I think about if I was the general counsel or chief compliance officer of a bank? kind of after the dust settles, is how do I really invest in the capability to identify in a very precise and tailored fashion, mitigate risk, and then build my financial crime compliance programs around a much greater or more enhanced risk identification and mitigation framework. That's how I would be thinking about this, because I think one thing that we've learned and that FinCEN and the other regulators have recognized is that you can't do everything equally well. And then when a crisis comes, you've got to really focus and prioritize. And so building the institutions that allow you to focus and prioritize in advance, I think, is how you're going to mitigate risk when it really counts.
Let me maybe just push back a little bit on you guys, because I've been hearing a lot of, you need these plans, you need well-articulated plans, you need to focus on what's going on in advance, but like, you have no idea. Nobody, there's so much uncertainty at all levels. How can you actually do that good kind of planning? And I want to fold in as well a couple of questions that we've gotten from attendees, and one is more specific about tech. So are we thinking about completely new technology systems? Are there band-aids and ways to improve current technology systems? Where should those investments be? How do you think about maybe tech in planning? And then the kind of a second question is a bit more about what happens when this is over? What does the world look like? And then what kind of planning would that mean? Is it a new world, or are we going to go back to the way we were before? And how should financial institutions kind of shift their thinking going forward?
Well, Stacy, I think we need to redefine the office. And I think that's been very clear through this crisis and even before. So I know many firms, their employees were able to literally, once they heard there was a case in their building or they were leaving town, they picked up their laptop, left, and when they sat down at home, they were working like they were in the office. And so, like I highlighted, I really think it matters how much you've invested in technology and getting over this antiquated view of the office. And I think we get very, very much in the pattern. So whether it's investing in systems like Slack or Zoom technology, or being able to communicate clearly, that's going to be important. So I think it's a reversal of mindset. And I think it's very clear to me, looking at some of my peers who have invested in that and who are playing catch up right now.
Yeah, I would add to that, but I guess I'm a bit schizophrenic about the whole issue. I'm an old timer, so the idea of people working remotely has always bothered me. It's bothered me because my feeling was you lose collaboration opportunities, and it's more difficult to supervise from a perspective of productivity and quality control. But this has taught me, I guess this has taught me that there are ways to achieve a lot of that, the benefits of an office environment, while allowing people to work remotely. And there are things that you can do. Even, I'm on the advisory board of a group that does testing for certification. They're figuring out how to proctor remote test taking, because it was thought that was really not possible to do from a remote perspective. So I think it's pushing us to think about how we can achieve the benefits of, as Michael refers to it, the office in a remote environment. And I think if we get good at that, we're going to see people move away from the office environment because it's expensive. And this is an efficient way to do business if you can get the benefits of that physical environment.
Yeah, either that or people will be so happy to be near each other again that they okay, so I do want to leave enough time to kind of talk about regulation, but let me just bring up one other risk that somebody brought up as a question, which I think is important for you guys to address. And this is this idea that you've got a combination kind of a dropping in cross-border activity, but at the same time, so much fiscal, coming from not just from national governments, but also from the IMF and the World Bank, and so much cross-border flows How do you think about that kind of cross-border financial crime risk? Should we be thinking about it differently? Should we be hyper worried about that now? And maybe just some thoughts in that space.
Yeah, we are, this is one of the points I made, I think, initially. We're going to see a lot of cross-border activity that's related to frauds and scams, and we always have, but we're likely to see an uptick in it, and people will try and take advantage of people's fear and anxiety. They'll hope that the institutions are less well prepared to monitor and surveil, and all that will result in increased activity that's illegitimate. But having said that, we know financial institutions know how criminals do this generally, and they can help protect their customers from this kind of activity, both, as Michael said, through training and education of their customers as to what they should be looking out for, but also in terms of tuning their automated scenarios and in high net worth situations like Michael's familiar with. You know your client, you know your client's activity, and if you detect aberrant behavior or things that are unusual, that's the kind of thing you should be jumping on. And so staying vigilant around their surveillance and monitoring and assurance processes within an institution is going to be really important.
Okay, Zach, anything to add before we start talking about kind of what's going on regulatorily? Okay. All right, so what's going on regulatorily?
So, FinCEN has released guidance in the last couple of weeks, and the OCC and others have released guidance specifically about BSA-related matters. And effectively, what they're saying is two things. One is making very specific accommodations in certain circumstances. So, allowing for delayed submission of certain reporting requirements and certain accommodations in the context of beneficial ownership collection information for existing customers. I think those are probably the two most impactful changes that the regulators have made. But I think in FinCEN's guidance released last week, I think they reemphasized, I think, what a lot of us have been saying explicitly, which is the importance of the risk-based approach. And I think when you really unpack what the risk-based approach means, it means that it recognizes that resources are limited and that financial institutions have to prioritize the highest risk, customers, accounts, products, services, geographic areas, et cetera. So again, what I'm thinking most about as I think about responses, both in the context of the crisis and then when we move beyond it, hopefully sooner rather than later, how do financial institutions and others need to think about reconceptualizing their compliance architectures, risk, really being very sophisticated and precise in thinking about risk, and then building programs around identified risk is where I would invest my energy.
Bob, what are you seeing out there?
Well, and I saw there's just another question that came in that's spot on. We've got all kinds of government programs globally coming into play, a tremendous sense of urgency politically and economically to provide assistance, and institutions that were already strained by their remote operational capacities. It's almost a perfect storm for institutions in terms of trying to find the ability to balance the need to, as Zach said, to apply appropriate controls around who are these people who want these loans? Do we know them? Do we know what they're going to use them for? With the need to get the relief to the public as it's intended. Right. And it's going to be a tough one because in the moment of the crisis, particularly the political branches of government will be screaming, banks, you're slowing things down, you're disrupting the process, get those funds out. But after the fact, they're also going to be the first ones to say you had inadequate controls, your infrastructure was terrible, you allowed rampant fraud, you wasted money, you diverted resources from people who needed it. So the institutions better, they better be careful in how they administer this. And some of it too is that the programs are not clear. Forms are changing, guidance is changing, guidance is inconsistent. And so the financial institutions need to push back on that as well and say, look, we want to comply, we want to move these things administratively through the process, but you need to give us, instead of changing the standards every day, you need to give us a clear set of rules around how we're supposed to administer this stuff.
You know, there's a question that that addresses that a little bit more finely, which is, you know, how much should banks be actually paying attention to this, given that the guidance changes and can be a bit contradictory at times, et cetera. So should you, I mean, of course, you're going to say they should take it seriously, but how should banks think about kind of keeping up?
Yeah, I mean, again, that's the conundrum, right? Because in the moment, there's tremendous pressure to just get the relief to the businesses and people who desperately need it, and they do desperately need it. But after the fact, regulators historically have shown an ability to time travel and to tell financial institutions they regulate, well, yeah, we wanted you to get it out, but we wanted you to get it out safely and deliberately, and you didn't, because your program was inadequate and it should have been better at the time and you should have known at the time. And so institutions should expect they're going to have a retrospective view applied to everything they do today that's going to be with 2020 hindsight. And so I guess my advice, and it has been my advice to my clients, is put resources into moving, put the personnel and the technology that you have into executing these programs, but do not compromise your standard, well-known risk assessment and mitigation processes, because if you do, it's going to bite you in a year or two when everything's settled and all the auditors come running in to look and see how these programs were executed.
Yeah, and Stacy, I think institutions also really need to be agile during this time, because you saw with the disbursements here in the US, the House was considering creating a digital dollar. And that would mean for the Fed to be sending out those payments digitally. And that may come in a future stimulus. So I think not only do banks in the US need to be prepared, but other central banks around the world and institutions may be seeing more use of digital currency and crypto. And as Bob and Zach know, that opens up a whole host of risks and implications, not only for the future of the dollar, but for currency and disbursements moving forward. So I think it's going to be a constant ability to adapt. And I think those are going to be the institutions that ultimately are going to be most successful once the dust settles, is who can adapt quicker, and to Bob's point, who can do it in a safe manner.
Zach, do you have anything to say to that, or on this round?
No, I agree. I mean, I think, obviously agility is incredibly important, and I think, that there's no perfect solution, and balance is key. I mean, I think abandoning time-honored controls not only is going to be counterproductive from a particular institution's perspective, because you open yourself up to post hoc criticism, but also, frankly, undermines the objectives of these programs, which is to say that if criminals are getting access to finite, these programs are huge. $350 billion in small business support is a lot of money, but this is a big country. And every dollar that goes to a criminal or a fraudster is a dollar that does not go to a small business facing a real need. And so I think it is counterproductive to abandon kind of time-honored controls on distributions of funds and access to loans and things like that.
Okay, let me be a schizophrenic client. So and I'm going to be a bank, and then I'm going to be a policymaker, and I'm going to ask you for advice. You know, on the one hand, I'm a bank. I'm telling you, look, in the United States, this PPP program, I get to charge 1% annually on loans. It's a 2-month loan. I'm maxed out at 2.5 times payroll. This loan's going to be $500,000, kind of mostly, if I'm lucky. I'm gonna make about $800 on that loan. You really want me? And AML, CFT has high fixed costs. Are you advising me to give this loan to new clients? I mean, wouldn't I just? I'm happy to extend this to clients that I already know, but like, you can't possibly be telling me that I should extend this to clients I don't know. Now I'm a policymaker, and I'm saying, look, this PPP assistance is not just meant for the good clients of the SBA provider banks. Like, this is meant to be a policy for the country. So what advice do you give me? How can you help us walk that path?
It's a tough one. It's because, of course, the banks are going to want to deal with the people they already have the KYC on. And I can see how, in many cases, that might undermine the principles of the program. It's a tough one for me, and some of it may go to how familiar I am with the way the SBA provisions work and how many banks are participating in it. But any legitimate small business that has payroll and rent is overwhelmingly likely to have a bank account. I mean, there could be exceptions to that, but they're going to be far and few, which means they've got a relationship with a bank. I guess the question is whether the bank they have a relationship with has access to this program or not. And it may be that the way in the future, it may be too late now, but going forward that we need to deal with that is have provisions for those banks they have a relationship with, essentially to act as a broker for them with the banks that are in the provider system. And that could greatly expedite, I believe, the ability of the provider banks to process their applications, particularly if they've got a regulated institution who's representing that customer.
So a little better reg tech, soup tech also could be what's in order as well. Yeah. All right. So we're getting some questions really coming in, and in the last 15 minutes, why don't I just start going through them, and anybody can kind of take them and use them as well as an opportunity to give additional thoughts. But how flexible should regulators be to innovate now versus doubling down on controls that people know already and trust? Is this a space for innovation right now, or should we just be extra cautious?
I think it's a little soon to be extra innovative right now. I think that there is so much happening that you need to see. I think give it a little bit more time and to make step-by-step adjustments to make sure that you are being proactive, but also safe regarding that laws and new guidelines are changing and are in the process of being drafted. So I think you do need to be innovative and agile, but at the same time, you need to be patient.
Yeah, I mean, look, in 2018, FinCEN and the banking regulators released a statement on their support for innovative approaches to BSA compliance. That support was reiterated in the guidance that FinCEN released last week. And if there's any time to, I wouldn't say experiment, but I would say hopefully reinforce processes of innovation that have existed already, this is it, right? I mean, when else are you going to start to put these kinds of solutions to the test? Again, I think doing so in a controlled and incremental fashion is critical, not abandoning established processes. But if there are places where, some new software programs or new ways of managing data flows can help incrementally relieve burdens on compliance systems that are stretched to the max, this might be a way to do it in a controlled fashion.
Okay, let's go back to I think an interesting question about sort of the bank lending programs and some of the unintended consequences there. Is there maybe going to be, as an unintended consequence, a kind of flight to quality for lending with a government guarantee and to the detriment of regular lending that is based on sort of creditworthiness and due diligence? Do you see kind of a shift coming out of this afterwards that could be problematic?
My own view is that in the short term, you will see that because the focus now is on these programs and executing them, and they're intended to provide a basis for banks moving money quickly at little or less risk to the banks. I don't think it's going to be a long-term phenomenon. I think once these programs wind down, particularly given some of the politics around them, that you'll see banks refocus on their traditional lending activities.
Okay, and then a couple of questions going back more towards a global tilt. So one is, what about and again, kind of bringing up this cybersecurity element again, what about a coordinated global attack on the world, global correspondent banking system? How worried should we be about that? Is this not a good opportunity for that? How would we think about that? And then as a related question, does COVID-19 itself bring geopolitical changes to the world that maybe increase the risk factor of certain areas, certain geographical locations versus others, or certain kinds of business or certain kinds of flows? Is there a shift in the way that we should be thinking about those risks? So maybe I'll open that up, and maybe for this one, I see some nodding, so I'll just kind of go around the room. Michael, I'll start with you.
Sure. Well, I'll take the second part, Stacey. I think geopolitically, we're seeing an ongoing great power competition continuing between the U.S., China, Russia, and others. I think the key question when this crisis started was where are supply chains going to move going forward? Is there going to be as much reliance on China for supply chains and businesses, and how are they going to change their operations moving forward? So I think the supply chain will be a very important space to watch. Geopolitically, it's all about narrative. It's which country is coming out of this stronger, who has handled it better, who's sending supplies, and who's taking the lead. So I think China's obviously trying to constantly rewrite its own narrative and use propaganda to do that. I mean, if you look at a country like New Zealand, for example, and their leader there, they have been very proactive in this regard. So it'll be interesting to see how they come out of this economically. But ultimately, this is a time where there are a lot of weaknesses being brought to air. And I think it's going to be important to see whose narrative can be most clear and strengthened after this.
Okay, Bob, how about you? And also on the correspondent banking and the geopolitical and...
Yeah, the correspondent banking questions are really, I think that's a really interesting one. We know that in times of crisis, which increase vulnerability, that's when there's increased likelihood of systemic or systematic attacks on the vulnerable institutions. I think the idea of a coordinated attack on the correspondent banking system is an interesting one, most likely to come from a rogue regime, to be honest, rather than criminal enterprise. Someone looking to maximize disruption, a regime or collective. And I think it's most likely to come, if it comes, on the payment platforms that are used to process the payments, probably outside of financial institutions' proprietary systems. So if I were SWIFT, I would be, for example, incredibly vigilant right now about a systemic attack on the SWIFT network and other payment systems of that kind. And this is, to go back to a previous comment that Michael made about crypto, this is also where people are going to begin to see the value of a more simplified payment system and a more modern payment system, like the blockchain technology that's out there. So it may have implications for what people see as viable and attractive going forward.
As a follow-up.
Yeah, I mean, I would add to that. I think you've seen the statistics to bear out Bob's comment that certain, in particular, stable coins, which are privately issued crypto tokens that are tied to an underlying asset, usually a currency like the dollar or the pound or the euro, something like that. There's been a spike in volume in those stable coins in the last couple of weeks, which suggests that folks are moving transactional activity into these kind of parallel platforms. I mean, I think it's interesting to think about an attack on a payment network and stressing correspondent banking systems. My impression, and this is purely anecdotal, is that the risk conceived of both in terms of likelihood of action and magnitude of impact is lower now because transactional activity and economic activity as a general matter is substantially reduced, right? And so I worry there are certain types of systems that are getting stressed, but I think it's because they're being used in ways that they were not intended. And I think Michael and Bob did a great job of addressing these kinds of risks in the beginning part of the hour. But I don't get the sense that the global correspondent banking system is buckling under the weight of transactional activity or things like that. My sense is, in fact, quite the opposite. I think the real risk from a kind of malicious actor attacking perspective, and I think folks address this in the discussion, is that security personnel at these institutions have been affected in terms of their ability to do their jobs just like everybody else has. And it's not that the weight of the pressures are overwhelming them. It's that, there are gaps and seams that didn't exist, a month ago, owing to the fact that people are facing unprecedented challenges just in doing their day-to-day job.
And
I think that's
Stacey,
true both on the cybersecurity front and on the financial crimes compliance front, right? That malicious actors who want to take down systems may have a slightly easier time doing so, and malicious actors who want to try and exploit the system for financial gain may have an easier time doing so.
Yeah, and Stacey, I think what you're seeing geopolitically in addition is the dollar. The US dollar is under attack not only by China, who is going to be coming out with its own digital currency, but you're seeing workarounds play out with the European system to have humanitarian payments with Iran, with other central banks creating digital currencies. And there's a mantra that there's going to be a basket of currencies trend going on. Even with a surging dollar, I think there's going to be a constant attack on the US dollar because they don't want to be tied. Countries don't want to be tied regulatory risk-wise to the dollar. And so you're going to see that trend play out, and it's going to be very interesting for banks globally to watch how other countries treat the dollar. Whether they're pegged or not, it's going to be very interesting to see how that plays out.
Yeah. So any predictions there about sort of, and you don't mean the dollar in terms of the relative value of the dollar, of course, you mean the dominance of the U.S. kind of financial system. Right now, dollars, I think it's like 65% of export volume, and it's about 65% of reserves worldwide. Are we going to see that number go down in the next 5 to 10 years, do you think, gentlemen?
I think the dollar's dominance is going to continue. I don't see the global reserve status changing anytime soon, but I do see there's going to be more of a basket of a currencies approach, and you're going to have more optionality. So the dollar is predominantly the leader right now, and it's going to take a long time for that to change. But and during a crisis, as we've seen during this, everybody wants dollars. Everybody wants dollars on hand, and you've seen central banks trying to keep more dollars within their systems. So I think going forward, it's going to be, can central banks regulate digital currencies? And if central banks play that role and it starts to become part of the norm, even if the Fed starts it with there's these surplus payments, that's going to be an important trend to watch.
All right.
Yeah,
Okay.
just to emphasize Michael's point, I mean, treasuries are the classic flight to safety asset. That trend has only been kind of emphasized in the last couple of weeks, right? Interest rates at sort of all-time lows, and I don't see that changing. I mean, we have seen over the last several years, episodically, people shifting to different currencies in certain circumstances, but I think the status of dollar-denominated bonds and U.S. government debt as a flight to safety asset, I think, has only been reinforced.
Okay, Stuart, I see you're coming in to wrap us up. We've got a couple of more questions, but they are still, I think, in the zip code of some of the themes that we've talked about. So we can, Stuart, you can kind of get some email responses if you want to those. But why don't I turn it back to you? I want to just, before I do though, thank you guys for your insights and your willingness to kind of go out on a limb a little bit and say things. And I think it was a super interesting discussion, and we're very happy to have you on it. And Stuart, why don't I turn it now to you to kind of sum up? But you need to be off of mute in order to do that. It's very technically, we've had a lot of guidance from Michael and others about the importance of understanding technology going forward.
We have a resiliency plan at Sigma. I will tell you.
You have a very good plan.
A very good plan. Well, first of all, we are on the hour. Thank you very, very much, Stacy, for bringing so much energy to the discussion. Great discussion overall. Thank you, Bob, for joining us. It looks like you have the best view and background of everyone, so stay safe.
The next one is going to be at your house, Bob.
Yeah, we're going to at your house, Bob. And Zach, thank you as well. We had some technical challenges, but thank you for bringing your wisdom and insight as always. And Michael, thank you as well for joining us. I think just a tremendous panel. We hope to do more. If this is the sort of content that folks are interested in that have joined in, please email us, hello@sigmaratings.com. If you did not get your question answered, we will try to respond to all questions. Just please send them in there. And then also the sort of last housekeeping item is that we will be making a recording of this available. Stay tuned for details on that. But thank you again for everyone on the panel. Thank you, Stacy, and thank everyone from around the world who took an hour out of their time to learn and to participate in what I think was a great discussion. So with that, I'll sign off. Thank you, and we'll be in touch. Stay safe.
Thanks, everybody.
Thanks, everybody.
Thank you.